overhead costs, they have calculated in different way. So anyhow we have calculated, no, we have found it. Right, fixed overhead cost variance, standard fixed cost. We already calculated standard fixed cost, 102,000, and actual overhead cost is given this amount. Right, therefore the variance is so 12,750. We see here fixed overhead cost variance, the difference between standard fixed overhead minus actual fixed overhead. Right, standard fixed overhead is given. This is 102, and actual fixed overhead 114. So the difference, the firm spend than the budget, than the standard. So it's adverse. It is adverse. Second one, fixed overhead expenditure variance. Right, expenditure variance. Just be careful about budget. Right, so budgeted fixed cost 100,000. Budget fixed cost 100,000. Actual overhead cost 114,750. It's right. It is straightforward. Fixed overhead expenditure variance. Budgeted, not standard. Budgeted 100,000 for 25,000 units. Actual overhead cost 114,750. So the difference is adverse because the firm spent for fixed overhead more than they budgeted. So it's adverse. It's not favorable to the firm. It's a cost, additional cost to the firm. Right. Then fixed overhead volume variance. Fixed overhead volume variance. Here, budgeted hours. The formula is the volume, right? The volume, the difference between budgeted hours and standard hours. Budgeted hours and standard hours in terms of rate. If we use direct labor hours, not production. Now we use hours. If you use hours, now budgeted hours, how much? How much? 50,000 hours. No, it's given. 50,000 hours is given. Labor hours per month 50,000. It is given, right? So 50,000 hours. Standard hours we calculated 51,000. The difference budgeted hours. Budget hours is mean allocated hours, but standard hours. Yeah. Budgeted hours 50,000 and standard hours 51,000 hours into standard rate per hour. Standard rate per hour. This is a standard rate. How do we calculate? Total cost 100,000. If they work 50,000 hours, so therefore per hour 2 rupees. So it is calculated here. Yes, here. This is standard rate. The standard rate per hour. Standard hours per production, and per hour 2 rupees. So total the firm need 2 hours for 1 unit. And to produce 1 unit it requires 2 hours. Per hour rate is 2. Then unit cost is 4. Right? This is how they have calculated. Fixed overhead volume variance, budgeted hours minus standard hours. Right? So that's a difference. How many? 1,000 hours. Right? 1,000 hours different. Standard rate per hour 2. So therefore 2,000 favorable. 2,000 favorable. So why? Yeah, do you have any questions regarding why do we have favorable? It should be favorable or adverse. It should be favorable or adverse. 2000 or 2000 rupees. Adverse or favorable? Budgeted hours. So they are getting right standard hours more than the budgeted hours. Right. If you have doubt, let me know. Right. It's a favorable, right? It's a favorable. They allocated 50 hours, but they estimated 51 hours, 51,000 hours. So 1,000 hours additionally they are work taken for standard. If they work for 2 hours per hour, if they have to spend 2 rupees per hour, so therefore 2 into 2,000 is favorable, not adverse. Otherwise, fixed overhead volume variance, so we can calculate in another way. So budgeted production is 25,000, right? Budgeted hours, budgeted production 25, and actual production 25,500. 25,500 into standard rate of production 4 rupees. How we get 4 rupees? To produce 1 unit of the product, it requires 2 hours. It requires 2 hours. Per hour, 2 rupees. So therefore, 4 rupees that has taken into standard rate. Even if you take standard production, there's no term called standard production. Standard production, how much? Even though if you take standard production in terms of units, it also 25,500. You see here, standard production 25,500. So the difference between the budget and the actual, or budget and the right, budgeted and the standard. So the difference is 500. 500 into 2 by 2, 4. So therefore 2,000 favorable. Again, you may have raised the question, why does it favorable? Why does it not favorable? So that is fixed overhead volume variance. Then we have fixed overhead capacity. Fixed overhead capacity usage variance. Capacity variance, simply called capacity variance. Budgeted hours 50,000, and the difference between budgeted hours and actual hours into standard rate. Budgeted hours 50,000, actual hours 44,000. Actual hours. These two given. Then the capacity 50. Actually, they have used 44. Therefore, they use less. They use less hours than allocated. So it is a cost to the firm, unused capacity of the firm. So therefore, it was a adverse. And fixed overhead cost variance. Fixed overhead cost variance. fixed standard cost overhead cost variance. Here standard hours. Standard hours. It's given 51,000 hours. So they are comparing what standard and actual. Standard was 51,000 and actual hours 44. It's favorable, right? So this is 12,000 cost variance. See, fixed overhead volume efficiency variance. It should be fixed overhead volume. It should be efficiency variance, right? It should be efficiency variance. Right? It should be efficiency, fixed overhead efficiency variance. Normally we use the same formula, no? That was actual production, actual hours, like that. Standard hours minus actual hours into standard rate. Therefore, 12,750. It's not come here. Actually, it's not come here. It should come here. Right? It should come here. So the fixed overhead can be divided into this 12,750 adverse coming from here. Right? Fixed overhead cost variances 12,150. It should be divided into two. The root cause of this 12,750 is coming from fixed overhead expenditure variance. So due to the rate differences, and fixed overhead the volume variances, right? Volume variance here 14,750, 2,000. This is favorable. This is adverse. So therefore, adverse is supersede. So that's 12,750. So this 2,000 favorable causes due to fixed overhead capacity variance and fixed overhead volume variance. Capacity variance we already found 10,750 and fixed overhead volume variance. It's not volume variance. Fixed overhead efficiency, volume efficiency. Fixed overhead efficiency variance. 12,750 favorable, right? So it's little confusing, right? It's not only you. So this is common when we study the variance analysis. Many students got confusion about when we study the fixed overhead related variances. Anyhow, when you go through this, we can get some clear idea, right? So here to have practices, since we are not in exam, you are going to assess using the assessment basis, assignment basis. So it's not much hard. So when you use it for the exam, final examination, the student has to remember all the formulas in mind, and they should know the implication as well. But you are going to submit assignment now, so it is not much difficult to you. You can manage it. Right. And here, right, the reason for it. So do you have any doubt here as I ask you? So why, even though here it is minus value, why we call them as a favorable? Yeah, here also favorable. Why? Don't you have think about this? Even though we are getting negative value, why we take it as a favorable? Why? Why is that? until you don't know, until you come with the confusions, cannot be cleared. Right. So in the fixed overhead analysis, there are some ratios here, but so for your explanation, not only for the assignment, when you're working in your company, then the accounting manager, financial accountant may submit some sort of reports. He may use some technical terms, ratio analysis. You should be able to understand the meaning, real implicit meaning. Right. Reason for fixed overhead cost variances. Fixed overhead expenditure variance. What the cause of that expenditure variance? The favorable. So changes in nature of overhead used, overhead cost reduction or savings. So that's the reason for overhead expenditure variance, expenditure cost. This is based on the rate differences. Adverse changes in the nature of overhead cost used and increase in overhead because this is the overall expenditure, right? Fixed overhead volume variance. The volume means a number. The reason favorably increase in the actual production. Increase in the actual production. That could be the reason for consider the fixed overhead favorable. And the adverse reduction in the actual production. Right? Do you have any doubt here? Please let me know. Then at this moment, I want to re-emphasize the behavior of the cost. So there are variable cost and fixed cost. Variable cost and fixed cost. The variable cost may include direct labor, right? The cost may include the variable cost and overhead cost. Right. Fixed cost. Variable cost, fixed cost. Variable cost may include direct labor, direct material, and direct other cost. Direct other cost. So the direct other costs, we call them as variable overhead. Variable overhead. There are some fixed costs, right? There are some fixed costs called indirect labor or indirect material. Sorry, right? Not indirect material, right? Not indirect material. Another cost, like for example, machine rent, or land rent, insurance. So those kind of things are fixed. When you look at the behavior of this cost with regard to the production, yeah, this is a cost in terms of rupees, and this is the number of units quantity of output. So here, so there will be two costs. One is fixed cost. One is fixed cost, say 10,000. Even the production is zero, right? You have to bear this 10,000. When the production has increases, even to 1 million units, the cost is same. It's called fixed cost. It's called fixed cost. For example, if we decided to make a new production, we have to buy a machine, or we have to rent out a machine. We have to construct a house or a factory building, a factory, right? A factory, and so many things like that, right? That is fixed cost. Another cost, when you start production, then some costs may incur, right? For example, direct labor, direct material. So those costs, if there is no production at the organization, it should be zero. When you enhance the production process, when you enhance production, when you produce more and more output, the cost increases, right? More production, no production cost, no production, no production. So this is called variable cost. Variable cost. So a variable cost and fixed cost altogether, right? Even though the production is zero, the total cost at this point is zero. The 10,000 that is equal to fixed cost. Then it's like this. Total cost. It is parallel, right? This is space equal to this is space. Let's say 10,000, right? 10,000 would be a fixed cost. 10,000 fixed cost. Assume that, right? 10,000. 10,000. Fixed cost, total fixed cost. During the period, if the firm spend like 10,000 and the number of output, say in 20, right, in 2022, they produce production, the number of units they produced, say 1,000 units. Then how much fixed cost per unit? How much fixed cost per unit? How much?
10 rupees.
10. Yeah, 10 rupees. 10 rupees. If the production is 2,000 units,
50 cents.
how much?
5.
5.
5.
5 rupees. 5 rupees. If the production 5,000,
2 rupees.
2 rupees. If the production units increased 10,000,
1.
1 rupees. If you produce 100,000 units per cost, unit cost, isn't it?
10 cents.
This is how it behaves. This is how it behaves. You purchase a machine, you rent a car, right? Or you rent a machine. Whether you have used the machine to just produce 1 unit, to produce just 1,000 units, to produce just 5,000, 10,000, 100,000, we have to pay that 10,000, right? One time payment, 10,000, right? So when we see the behavior of the fixed cost per unit, it looks like this, the graph like this. If you write 10,000, maximum 10,000, maximum 10,000, if the production is zero, right? The point is here, right? When they increase the production, right? Production, the fixed costs behave like this. Isn't it? So when they increase the production process into when they increases, the cost per unit is reduces, right? It is reduces. That's why, right? They purchase a machine. They purchased a machine that can be work, or they rent a machine. Company, the manufacturing firm, rent out a machine. right? Rent out a machine to produce 10,000 units. 10,000 units, but they produce only 5,000 units. It's adverse or favorable production. The production units. They budgeted production 10,000, but they actually produced 5,000. It's adverse or favorable?
Adverse.
Adverse. So here the machine has purchased. The machine has rent out for 5,000 hours. Rent out for 5,000 hours. Rented out. But actually, actual hours, it has been used for, right, 6,000 hours. Adverse or favorable? When you get the machine rent out, right? You estimated 5,000 hours of work. Estimated. It's been budgeted 5,000 hours, but actually you use for 6,000 hours. This is favorable or adverse?
Favorable.
Favorable. Why? Why you say favorable?
1,000 hours we have get more benefit.
Right. We use additionally 1,000 hours. We use this machine additionally 1,000 hours. Then if we use this machine additionally, we can produce more units, more production. When they use this machine for long hours, they can produce more product. And then if they produce more product, what will happen to the unit cost? Unit cost of production, unit cost per, sorry, fixed overhead per unit. What happened? I repeat again, I repeat, right? You bring a machine, right? You bring a machine. So the cost of the machine is 100,000. Cost of the machine, 100,000 rupees. You budgeted production, say 10,000 units. 10,000 units, budgeted production, 10,000 units. And budgeted hours, budgeted hours, say 20,000 hours. 20,000 hours. Right? Then accordingly, right? If they use this machine to produce 1 unit, what's the cost? To produce 1 unit of output, what's the total fixed cost per unit?
10 rupees.
10 rupees. If you use this machine for 20 hours, estimated cost is 100,000. Then how much per hour? Per hour? 5 rupees. Right? Am I right?
Yes.
Right. To produce the product 10,000 units, the machine should work 20,000 hours. To produce 1 unit, how many hours it requires? How many hours it should be operated? To produce 1 unit.
Sorry, excuse me. I didn't get the question.
Yeah, to produce 1 unit of output, how many hours this machine has to be worked? Simply, right? 20,000 hours or 10,000 units. Then 1 unit, how many hours it requires? 2 hours, no? So we need 2 hours. Am I right? Clear? Then how much cost, right? Here, cost per hour, right? Cost per hour is 5 rupees. Cost per hour, 5 rupees. Cost per production, 2 hours into 5 rupees equal 10 rupees. This is similar to this. My question, my concern is, right? My concern here to understand why it is favorable, why it is adverse. Whether you have produced 10,000 units or whether you have used 20,000 hours or 25,000 hours, 30,000 hours, no matter, this 100,000 cost already incurred. Even if you produce 0 units, you have to bear this 100,000 rupees as a fixed cost for that machine. Do you agree? Do you agree on this statement? Whether you
Yes.
produced 20,000 or 20,000, 100,000 or whatever the things, or if have you use this machine any hours, you have to pay this 100,000 rupees, right? Right. My question here, my question is, my question is, if they produce budgeted units 10,000, budgeted units 10,000, actual production 9,000, 9,000, sorry, 9,000. It's adverse or favorable? Actual production, budgeted production 10,000. Actual production 9,000. Adverse or
Ad
favorable?
adverse.
Adverse. Why? Why is that? No, when we produce 10,000, per unit cost could be 10. When we produce 9,000, right, then we have to distribute this 100,000 by 9,000 units. So it's adverse. It is adverse, even though if the value, right, if the value is positive, 10,000 minus 9,000 equal 1,000 into standard rate, 10 rupees, right? 10 rupees, right? 10,000 budgeted hours, actual or standard hours, actual hours or standard hours, say 15,000, adverse or favorable?
Favorable.
It's favorable. The same way, at the budgeted hours, 20,000 hours. Actual hours, for example, 30,000 hours. Adverse or favorable?
Favorable.
Yes, favorable. So that is the logic. That's the logic behind the adverse favorable issue here. Fixed over volume area. Increase is in the actual production, right? Increase is in the actual production. Or for adverse, reduction in the actual production. This is the same, right? Same logic here. Here, fixed overhead volume variance. So I ask this is favorable or adverse. Now look at these statements. Budgeted hours 50,000, standard hours 51,000, then 2,000 favorable. Budgeted hours 25,000 and actual production, budgeted production 25, actual production 25,500, then 500 additional, 4 rupees standard rate. Clear? It is not simple as variable cost, right? Like variable direct labor, direct material, variable overhead. No, those are straightforward. If it is the minus value, we can directly take it as an adverse. If it is positive value, favorable. I accept the ideal variance in the labor. But in the fixed overhead, there are a lot of insights. You have to have in-depth knowledge on how cost behave, how production process, the mechanism of production. So now you can realize classifying the cost into variable cost and fixed cost. So variance analysis is not just numbers, right? Then you see here fixed overhead volume efficiency variance. Generally, fixed overhead rates are absorbed on the basis of direct labor hours. Therefore, right? So you just read it. Then the capacity variance. Capacity also, right? The machine capacity 10,000 units production, but we use only 8,000, 9,000. It's adverse, right? So employees are working extra hours, right? If the employees are working extra hours, they can produce more. Then we can use the maximum output from the machine at the constant rate, at the fixed cost. Right? Capacity, we use the machine beyond that capacity, right? We use that machine beyond the capacity. Okay. For having more in-depth analysis on fixed variable overhead, we can go through some ratio analysis. We can go through the ratio, control ratios, right? We can use this ratios for controlling their performance, right? Activity volume ratio, activity or volume ratio. We use here standard labor hours and budgeted direct labor hours. So it's regarding the fixed overhead, right? Fixed overhead cost. Fixed overhead cost. Standard direct labor hours or budgeted direct labor hours into 100. That is called activity ratio, right? Activity ratio. We estimated 10,000 units, but we produce standard hours is high. Then efficiency, right? You have a lot of activity. Capacity. Direct labor hours actually worked over direct labor hours, budgeted direct labor hours, and efficiency variance. Efficiency ratio. Standard direct labor hours over direct labor hours worked, right? Let us explain how does it work. The ABCX company has provided the following information for the month of June 2020. The fixed overhead cost 200,000, actual fixed overhead cost 210,000. Production unit 25,000, actual 30,000. Direct labor hours 50,000 and 45,000, right? So when we compare this budgeted cost, budgeted fixed overhead cost, and actual fixed overhead cost, it looks adverse or favorable when we compare the fixed overhead cost in terms of cost. 200,000, 210,000. Seems adverse or favorable?
Adverse.
It seems adverse because they have estimated 200,000, but actual 210,000. 10,000 is additional cost. At this safest level, it gives us a wrong interpretation. Right? We have wrong interpretation. To minimize this kind of misinterpretation, we have to convert this budget into standard. How do we do this? We have another column called standard. Standard, right? Standard cost. This 25,000, right? This 200,000 cost for 25,000 units. Actually, they have produced 30,000, right? 200,000 cost, 200,000 incurred for 25,000. Then per unit cost 8, but actual production is 30,000. Then 240. Standard cost is 240. It should be 240,000. Number of production standard, it should be equal to 30,000. And direct labor hours, right? Direct labor hours is 50,000 for 25,000 hours, right? 25,000 hours. So 20, so 50,000, right? 50,000 is 50,000. 50,000 for 25,000 units. Actually, they work 30. So therefore, it should be 60,000. It should be 60,000. It should be 50,000, 60,000. Okay, right? So see the differences: budgeted, standard, and actual. Right? Let's see first the activity ratio. Standard labor hours over direct labor hours, budgeted direct labor. Standard over budgeted direct labor hours. Standard labor hours 60, budgeted 50. So adverse or favorable? Adverse or favorable here? Direct, in terms of direct labor, they use efficiently or not?
Favorable.
Yes, favorable, right? They have used in favorable manner. Right. Here, look at here. Standard hours 60,000 and budget hours 50,000, 120%. So this means the company has achieved 120% of the planned target. So they did right beyond that. Accordingly, since the activity ratio is more than 100, this 120 is more than 100. The fixed overhead volume variance also could be favorable. Capacity, right? Capacity, right? The capacity adverse or favorable. Get here, adverse or favorable. Capacity ratio. Capacity, adverse or favorable.
Adverse.
Adverse because they bring that machine to operate 50,000 hours, but they operated only 45,000 hours, right? So 90%. They have utilized only 90% of the capacity. Accordingly, since the capacity ratio is less than 100, fixed overhead capacity usage variance, right, will also be adverse. Look at the efficiency ratio, standard hours, actual hours. Actual, right? Actual hours is also, right? Standard hours, they estimated for the actual production 60,000 hours, right? 60,000 hours estimated. But they did the same task within 45,000 hours. So adverse or favorable? It's a favorable, right? Why? To produce certain units, they allocated 60,000 hours, but they did the same within 45,000 hours. 15,000 hours but save. So the variance, of course, right? Different ways, different ways. By looking, right, so this is, I can share this material, we can go through this. To teach variance analysis, it requires at least 20 hours. Because that's how, so it has a lot of meaning. You see the root causes of this first fixed overhead cost variance. Root causes. So the 10,000 adverse may arises due to fixed overhead expenditure variance. This is favorable, but fixed overhead volume variance here adverse. The net effect 10,000, 50,000, 25,000, the net effect 10,000. Yeah, this is adverse is supersedes. Then favorable. 10,000. This 25,000 arises due to what? Two adverse variances. Those are coming from, one is capacity, another one is efficiency. That was the volume variances. Then we move to the next section, sales variance, right? Shall we have a break of 10 minutes? Shall we start about 10:30? Okay, we will start about 10:30. right now, shall we move? Shall we start? Shall we resume? Shall we? Okay.
Okay, sir.
Yes. Okay. Thank you. Sales variance. Sales variance. So there are different techniques used for sales variance, but in your assessment, there are two types of. There are two variants. There are two ways of calculating the sales related variances. One is turnover or value method. Second, margin, profit or contribution method. Right now we focus on this one, since in your assessment we are not going to test you on the sales variances, so therefore we are not going to test on the sales variance. But anyhow, to understand the usefulness of the variance, we should know, right? We have to start from the sales variance. Sales variance simply sales variance, say estimate, for example, sales variance can be arises in two ways. One is differences in price, selling price, and differences in quantity, sales in quantity. For example, the firm budgeted sales of 20,000 units, sorry, 20,000 rupees, but in the market goes 90,000 rupees. So this is the variation. This is the variation. This is variant. This variance called price variance because the difference in price. So this is adverse or favorable. This variance. Budgeted was the budgeted price 20,000, but in the market 19,000. Adverse or favorable. It is adverse or favorable price variance.
Adverse.
Can you hear me? Can you hear me?
Hello. Yes, sir.
Okay. Then tell me, you already planned to sell a product for 20 rupees, but when you go to the market to sell the product, it goes 19. So it's favorable or adverse to the firm?
Adverse.
Adverse.
Favorable, adverse? Adverse. It's an adverse, right? Adverse. Right. Quantity, they estimated 100,000 units. 100,000 units, but actual sales could be 120,000 units. So it is adverse or favorable?
Favorable.
Favorable, right? So it's not like cost variance. It's a revenue sides. It's a revenue sides variance. Normally happened when they reduce the prices, right? You know, this is demand curve, price and demand, quantity of demand. What happened if price go down? What's the relationship between price and demand? Positive or negative?
Negative.
Price and demand.
Negative.
So it's inverse. When they reduce the prices, when price increases, number of units selling unit may reduce. If they reduce the prices, they can reduce the sales units. Like so, right? That may happen here. They budgeted 20,000, but actually they make it sale for 19,000. So due to the reduction in selling price, may boost their sales by 20,000 units. 20,000 units. So price may be adverse or favorable. Quantity may adverse or favorable. We have to consider both, and we have to find this taken as a sales variance, right? So this is the introduction. This is the revenue side. So when we look at the variance, see variances, cost side and revenue side. This is revenue side, sales variances. Sales variance. This is profit variance. Profit can be selling and distribution, cost, production, total sales, yeah, sales. See the sales variance. So this arises in two forms. Sales margin. Types margin mean margin mean selling price minus variable cost. Variable cost. Selling price 100, variable cost is 20. How much margin? Sorry, 80 rupees. Variable cost 80. How much profit? How much profit here? Selling price 100. Variable cost 80. How much profit? 20. This 20 can be called in variance analysis different names like margin, right? Margin, sometime contribution, right? This contribution, right? This contribution or this margin or this profit can be varies due to sales margin, price variance, sales margin, volume variance. So this technique, right? We are using the margin, and here also it's a margin. There are two methods, as I told you, total variable method and margin profit method. So we are focusing on this, right? Not we are focusing. This is old method. Turnover value method is old method. We are most of the professional bodies are not test this, so they are following this because it gives a lot of insights than this method. Right. Now let us move on this. Sales price. Selling price. Selling price is a measure of the effect of expected contribution for different selling prices to standard selling price. Right? It's a comparison. Expected contribution, expected profit of a different selling price. Right? Standard selling price and the actual selling price. It's calculated the difference between the sales revenue. Right? Sales revenue should have been for the actual quantity sold and it was right. Actual quantity, actual selling price, budgeted selling price, budgeted quantity. If there are any differences among these four, those are causes sales variance. For example, suppose that standard selling price of a product X is 1,500. Right? Actual right? Standard selling price. Selling price standard, right? Standard selling price 1,500. Actual sales, the number of units, actual sales 2,000 units, but actual selling price 1,500. So they budgeted for 1,500, but actual selling price this, right? More than expected. They did, right? They did the sales for, right? And this value. The selling price variance calculated as follows. Here, the actual uh, units they are given, but we are focusing on price variance, right? Differences in price. Here, differences in price for 2000 units, it should be right based on the budget. It should be 1500. For 2000 units, it should be 3 million. But it was right actual. This is actual. Actually, we estimated 3 million, but actual sales 3.06 million. Then selling price variance. Selling price variance is 60,000 favorable. In simple term, we can write this formula, right? Actual sales, actual price minus standard price or budget price into actual quantity. Actual quantity. In material variance, we use material price variance. Material price variance, we use standard price minus actual price into actual quantity of use. So what's the difference here? What's the difference here? This is cost. Here we in the material cost variance we use the standard price at first, but we deduct from actual price. Earlier we deduct the actual price from the standard price, but now in revenue side we deduct standard price from the actual price because this is a revenue side, no revenue side income. This is cost variance. This is coming under revenue variance. This is a formula actually, but the logic is this. The logic behind, first we have to find the variances, price variances for actual quantity, right? So 60,000 favorable variance. The variance calculated is favorable because price was higher than the expected. Price was higher than expected. The second cause of such difference is sales volume, right? Sales volume mean the quantity, the units. Sales, that is sales volume contribution variance. Sales volume contribution variance is the difference between the actual units. You see the actual units sold and the budgeted or planned quantity. Valued at standard contribution per unit. Now here they use contribution. Contribution, right? Contribution. That's simple. No, not price. Yeah, they're not taken as a price, they are taken the contribution. In other words, it measures the increase or decrease in the standard contribution as a result of sales volume being higher or lower than the budgeted. So when number of units, right, sold in the market, it may affect on the profitability margin. Right? In the price variance, when we calculate the sales price variance, we didn't talk about the contribution price. We talk about only the price. The variance is causes due to the price. But here we test by changing the number of units of sales. How does it impact on the contribution? Let's see the sales contribution variance, right? So normally in the price variance, what we do, standard quantity minus actual quantity into standard price. But here, other way around, actual quantity of units and standard quantity or budget quantity into standard contribution. not price, contribution, right? Contribution. Suppose the company budget to sell 8,000 units. This is budget or standard. In sales variance, budget and standard considered interchangeable, right? But be very careful in their cost variance, especially the fixed overhead. So where there are a clear difference between budget and standard, but here no such differences. Company 8,000 units of product J for 1,200 units per unit, rupees 1,200. So here budgeted quantity is 8,000 and budgeted price is 1,200. The full cost per unit is 700. The actual sales were 7,700 at rupees 1,250. The actual, right? The standard cost, the cost standard cost is 700, right? Then there are two selling prices. We need only the cost, variable cost at standard. We need only standard variable cost. We don't want to worry about standard. We don't worry about actual contribution, right? We don't want to worry about actual contribution. We want to actual variable cost, right? Actually, we are consider only standard variable cost, right? Standard variable cost. Yeah. The full cost per unit, standard full cost per unit is 700. The actual sales 7,700 at 1,200 per unit. Here, the cost is 700 and the selling price. So there are two different contribution. Standard contribution, actual contribution. Standard contribution means standard selling price. Standard selling price minus contribution, standard contribution, that is standard contribution. And actual contribution equal actual selling price, actual price minus standard contribution, right? That's a difference between these two. Right. So we have found we should found standard contribution and actual contribution, right? Standard contribution and actual contribution. We know that selling price budgeted 1,200 and the variable cost 700. So therefore contribution 500. This is standard because we take the 1,500, that is standard cost. Right. And actual cost, actual selling price 1,250. 1,250 minus same variable cost 700 equal 550. This is actual contribution. Actual contribution. Right. Let's see. Budgeted sales volume 8,000. Actual sales volume 7,700. So therefore the differences of this sales units 300. And here they have taken standard contribution per unit. Standard contribution per unit. How they find? In this way, say standard selling price minus standard contribution equal 500. So 3 into 5, 15,000 adverse. Right? 15,000 adverse. The variance calculated is adverse because actual number of units were less than budgeted. This is due to sales volume. Sales volume means sales quantity. Sales quantity, price, selling price. Any doubt here? Anything else? Okay. Now you can do this This is question, right? You can do it by yourself. Right. This is the point here. The possible interdependence between sales price and sales volume. And there's a dependence, there's a relationship between sales price and sales volume. Sales price and sales volume. It should be obvious to you. The reduction in sales price might stimulate bigger sales demand. When you reduce the selling price, when selling price fall, what happened? It stimulate the quantity sold. So that an adverse sales price variance might be counterbalanced by favorable sales volume variance. Right? So when sales price go down, in terms of sales price variance, it may be adverse. But it boosts its sales now. So therefore, we can enjoy the favorable variance because of boosted sales. Similarly, the price rise would give a favorable price variance, but possibly at the cost of fall in demand, right? Cost of fall in demand and adverse sales volume. The way around. It is therefore important in analyzing unfavorable sales variance that overall consequence should be considered. So that is, there has been a counterbalancing favorable variance. So sometimes price give you, if you are focusing on price favorable variance, you may lose your volume variance adverse. Right? So that's it. Now this is the point. Operating statement. It's called operating statement. Reconciling budget contribution to actual contribution. Budget contribution to actual contribution. Right. So the term reconciling, right? Reconciling. This is not a new term to you. Right. Have you studied about the bank reconciliation statement? Have you studied bank reconciliation statement?
Yes.
Bank reconciling statement. Did you study it? Bank
Yes.
reconciling statement. Yeah. What the purpose of this? What the purpose of that bank reconciliation statement?
What are the checks to be realized and those things to analyze.
Right. So bank, right? Cash book. Cash book. In the cash book, we have a column called the bank. How much of money deposited? How much amount of money is available in bank account? Right, bank account. You may return your book, say 50,000 rupees in your bank account, 50,000 rupees or 5 million. And when you get the bank statement, you may get a different value, say 40,000. But there's a contradiction. No, the bank says your balance is 40,000, but your book says 50,000. So what are the cause of difference? What are the cause of these differences? Does the bank say lies? Oh, there are reasons for these differences. Hmm? So bank statement says 40,000. Your book says 50,000. So that's a difference. It's kind of variance. It's kind of variance. Then you have, as an accountant, you should know. You should know the variance, the reasons, the causes of this variation. So due to what? Unrealized check, unsubmitted check, or overdraft, right? And the bank charges. So due to that reason, right? Due to that reasons, these differences occur. Then you reconcile, right? Reconcile your bank balance, bank statement balance, say 40,000. And you compare the bank statement and your cash book. Then you write, so unrealized check and unsubmitted check and bank charges. So due to this thing, you may adjust it. When you adjust this thing, then you may finally end up with 50,000, right? 50,000 statement, cash book, cash balance. This is a statement. This is the statement. How this 40,000 and 50,000 got, what the reasons, how these differences arise. So these are the reasons. Some are having at plus value, some are having negative value, right? So these are the things. Likewise, as an accountant, right? Beginning of the month, beginning of the production, beginning of the operation, you submitted budget. You have submitted budget, budgeted profit, budget profit. This profit arises due to what? Revenue minus cost. Right. This cost arises due to direct labor, direct material, and overhead. So this is cost side. This is revenue side. Revenue side only, we have only one thing, that is sales. Then revenue minus cost. Say you estimated revenue 10,000. Cost estimated to cost 7,000. Then estimated profit 3,000. So this is budgeted. This is budgeted. The budgeted profit. But when you do in the operation, so there will be a differences. There will be a difference. You estimated 3,000 profit, but in the actual scenario, end of the month or end of the year, you end up with 2,500 profit. 2,500 profit. As an accountant, right? So this is actual. This is actual profit. Actual profit. Then you have to submit a report with the reason, right? The reason why we lose 500 profit. We budgeted 3,000, but actual profit 2,500. How we missed this 500? In the board of directors meeting, you have to present this. You have to present this. It's an account. If you are an account management account, you have to present this. The causes of these differences. Otherwise, you may blamed you are overestimated or you are underestimated. So this is the budget, it's the plan. The budget is the plan. The budget profit is the planned profit, actual profit. So the control, right? Now you come the point of control. Now compare budget and the actual figure. So differences. Difference is called variance. Then they have to take control actions. To take controls, right? They have to find the root causes. The root cause may be the loss we made loss due to uh, due to direct labor cost variance or direct material cost variance or overhead cost variance or in the revenue side, right? At a time, there are a lot of things may happen. It may give, right, material variance for direct labor variance favorable, direct material adverse, overhead, fixed overhead favorable, variable overhead adverse. Within direct material overhead, there are price differences and the usage differences, direct labor hours differences, sales unit differences, sales price difference. Some are giving favorable and some are giving you adverse things. Okay? So that's the requirement for that. Then, like bank reconciliation statement, we have to show the management, right? So this is my budgeted profit. This is my budgeted profit 3,000. This is budgeted profit, and this is actual profit. Actual profit of 2,500. So this is a variance. So what are the variances? The variances may be in sales and the cost. The sales variance, right? The revenue side sales variance, you may have a price variance and volume variance, units, right? Units and the price. And the cost, you may have direct labor, direct material, right? Direct overhead. Right? Then some of you have adverse, some of favorable. You have to categorize them. Then you have to prepare a report that finally these are the reasons, and by adjusting these things, they can reconcile the actual profit. So they are giving a roadmap. This is a roadmap why we arrive these differences. What are the root causes? Right. So this is statement called reconciling statement. Operating statement. Operating statement. Reconciling budget contribution to actual contribution. Right. Operating statement shows how combination of variances reconcile budgeted contribution and actual contribution. Contribution, right? The term contribution, it's very important. And you should clearly understand what is contribution. Contribution means sales, right? Sales and variable cost minus variable cost. What are the variable costs? Direct labor, direct material, variable overhead. These are variable overhead. Then if you get together all these things, and you should deduct from sales minus variable cost, then you will get a figure. That figure is called contribution. Right? So budget contribution and actual contribution. So far, we have considered how variances are calculated without considering how they combine to reconcile the differences between, right, differences between budgeted contribution and the actual contribution during the period. This reconciliation is usually presented as a report to the senior management at end of each control period. Some companies having control period every month, control meeting, some organization quarterly, some organization annually. The report is called operating statement or statement of variances. An operating statement is a regular report for management of actual cost and the revenues, usually showing variances from budgeted contribution to the actual contribution. So this is the report they are submitting. So this is the format, pro forma, right? This is the pro forma of contribution. They start from the budget. So they estimated budget contribution and two different courses, sales volume contribution variances, right? And then price variance, material variances, they have taken all together, and they have adverse and favorable. So adverse variables are listed here, favorable variable are listed here, and then combine these two, and they are finally arriving actual contribution. Here, one example has given to you. Sydney company manufactures one product, and entire product is sold as soon as it is produced. There are no opening or closing inventories, and work in progress is negligible. So we don't have work in progress issue. The company operates a standard costing system, and analysis of variance is made every month. The control period is every month. The standard cost and cost card for a product is as follows. Direct material per unit it requires 0.5 kilograms. Each kilogram 40 rupees. Therefore, to produce 1 unit of the product, it costs 20 rupees. Likewise, direct material, variable overhead, standard price. Then all these three together cost 186. Then selling price is 320. Then the contribution, that is standard contribution, is 134. The budgeted output for the month of 2017 was 5,100 units, right? This is actual, sorry, budgeted. This is standard, and by this budgeted output for the month, 5,100. Actual results for June 2017 as follows. Production 4,850, and the sales 1.503 million. Material consumed, this is actual, right? This is actual value. All informations are given to you. And material consumed for the amount of 2,000 kilograms at the cost of 98,000. And from this, calculated, and all labor information, labor hours, and how the cost, and operating hours, how many hours, and actual variable overhead cost is given, and actual contribution also has given to you. Then calculate all variances and provide an operating statement reconciling budget contribution to actual contribution. This is the question. Yeah. This is the calculation to calculate material price variance. They found material price variance 6,000, material usage variance 5,000 favorable, this price variance adverse, and labor rate variance 2,000 favorable, and the direct labor hours, right? The cost efficiency variance is favorable, and idle variance so given. All these things are given, right? All the variances are calculated. So I don't want to repeat these things because I have explained everything in the last class, how to calculate the cost variances and formula. Right. Now this is the statement. This is the statement. Start from budget contribution, end up with actual contribution. Actual contribution. How do they arrive from the budget contribution to actual contribution? So I give you 1 minute, 1 or 2 minutes. Please go through this. I have shared this material with you. Did you receive the material? Did you receive the material? Did you receive material? I have shared last week. I emailed. Don't you receive? Okay. Right. I give you 2 minutes. Please just go through the statement and just compare these variances, adverse and favorable, write each variances, and just have a look at on this. I give you 2 minutes. Right. Right. This statement shows the causes of the variations. So they start from the budget contribution. So 134 rupees contribution per unit. They planned 5,100 sales. So they receive this value. And the sales volume variance adverse 33,500 adverse sales volume variance. Yeah, this one. Sales volume variance. So budgeted sales volume variance. And then they receive this amount and the cost side. Then the sales price variance adverse. So this is all of these things about revenue side, and this is cost side. Material price variance, material usage, labor, efficiency, idle variance, overhead variance, variable overhead efficiency variance. All those things are considered favorable and adverse, and altogether, right? Altogether, 701,500 is actual contribution, right? So this is how they reconcile. If you add this statement in your assignment, it's right, it's a great assignment. Right, this is just a calculation. Now we come to the interpretation part. So this is a question it has given to you. And calculate the following for the month of December 2020. And so it's calculated. So here also they have given you a reconciling statement. Right. Deriving actual data from standard cost detail and the variances. So this you're not exam now. So we don't want to talk about this. Accounting for variances in integrated accounting. What do you mean by the system called integrated accounting system? What does it mean? Integrated. Integrated mean what? Combining two or more parts. Combining two or more parts. Combining two or more system into one system is called integrated. So integrated accounting system. Here we talk about earlier about financial accounting, and cost accounting. Right. So finance accounting, they report profit and loss, and cost accounting, they report what cost, and they report how much cost per product, and the management accounting, they are talking about budgeting and planning everything. So in an organization, there's a separate accountant called financial accountant and cost accountant and management accountant. So there are three different division of accounting, right? These three accountants normally work in a different setup, different field of specialization. But now a new system has introduced, right? Most importantly, the finance accountant keep separate books of accounts, right? Books of account, and they have double entry system. And cost accountant, they don't worry about the external side. So they are report the internal cost, how much cost they have incurred and how much the cost of the product, that sort of thing. Management accountants, so they're preparing budget and then short-term and long-term investment decisions, that sort of things. So they are maintaining three different books. Now, by keeping all these systems separately, it's hard to make a decision. So controlling mechanism, right? What the new system called integrated system, integrated accounting system, that is combination, right? That the integrate finance accounting, cost accounting, and management accounting in one system. You know, the double entry system. You know, the double entry, say sales. Can you tell me what the double entry for sales, cash sales, sales of 5,000? Can you tell me the double entry, debit and credit? What's debit, what is credit? Cash sales, what debit and credit? What is debit and what is credit? Imran? Imran, are you there?
Yes, yes, sir.
Yeah. Did you study the accounting?
Yeah. Cash
what-
book 5,000 credited, and sales book 5,000 debited.
Yeah. So this is the account. Right? What's the double entry for purchase inventory? Inventory purchase for 3,000. What's the double entry? Cash purchase of inventory. Cash purchase.
Debited.
Yeah.
In the inventory account, credited.
Cash. Purchase account debit, and cash account credit, isn't it? Am I right?
Yes.
This is the double entry system. This is the double entry system we are traditionally used in accounting. This is financial accounting. But how they are going to integrate this cost accounting within this double entry system? How they are going to integrate, right? Integrate in cost accounting, for example, the variance into the this WNT system. That's called integrated accounting system. Here, what they do is we have calculated the variances now. We have calculated the variances. Calculate the variances. Then you see this one. Material cost account. This is normally standard cost, right? Right. The cost account, sorry, these double entries, this says actual terms, or they recorded these figures are actual term or budgeted values in a financial accountant record, estimated value or actual figure, financial accountant records,
Actual.
actual. But in cost accounting, the standard cost is estimated or actual standard?
Estimated. Budget.
Estimated, yes, estimated. So what they do is, financial accountant normally record the historical transaction, and historical transactions mean the actual figure. But the standard costing is estimate. Now, what's the mechanism of integrating this actual historical cost, double entry, and the cost? For that, they have proposed a solution in this way. Here, they recorded at the standard cost rather than just actual cost. Rather than they follow actual cost, they use standard cost. For example, the purchase material, they may have different values, standard price, standard material cost, and standard and actual material purchase. Here, they are not recorded for the actual. Right? Record actual mean we can find the actual cost at the cash, how much cash. But here they debit the standard material, here material cost account, standard cost, right? They debit material cost. If there are any adverse, they are debit. If there are any favorable variances, they are credit. Then they are enter their books like this. Here, double entry system is coming from financial accounts. This cash payable receivable coming from financial account, and this is coming from cost account. This is coming from cost accounting. So this is how they are integrating cost accounting and financial accounting in one book. It's very hard, but now there are a system called SaaS, SAP, and SaaS. So they are developing a new system, right? That's right. If it is in favorable, right? They are credit favorable, right? So this is how they are introducing a new system called integrated system. So this may not help you for writing assignment, but anyhow you should know, right? You are doing the master level. You should know the current trend of accounting. So this is an example as given, right? Here the standard cost of labor is 60 rupees per hour, and 320 hours have been worked to create 50 units. The labor rate variance 2,700 favorable, and labor efficiency variance adverse. Determine the actual cost of labor and double entry required to record this entry into the integrated accounting system, not financial accounting system. If it is financial accounting system, you should get actual labor cost and amount paid or payable, right? That's what you have to account in the financial accounting. But now they are using integrated account. First, normally in the labor cost account debit and cash account credit. No, this is the normal practice in financial accounting. But since we are using the integrated cost accounting, first they have to record the labor cost as any standard, right? So per hour 60 rupees. Per hour 60 rupees. They worked 220 according to the standard. So therefore, the total cost, standard cost 19,200. And adverse variance, any adverse variance could be debited. The labor efficiency variance is adverse, so debit. The labor variance control account 4,350, right? And the labor rate variance is favorable, no profitability, so, right? And the labor variance control account. This is what credit. And how much cash paid? 20,850. This is the actual amount of actual cost. This is the actual cost of labor, right? Labor. You see the double entries, debit side and credit side. This is debit side. This is credit side. Those are tallied or not? Debit and credit balance or not? Both side balance or not? Both sides balance. So this is new accounting system. So I'm not going to expect this kind of reporting in your assignment. So don't worry. So this is for your knowledge. Right. This is the main point. You will write a report on this in your assessment. That's a question. Recommending action with the owners and timeline, and explaining the role of corporate governance. What's the role of internal audit? What's the role of external audit in assuring the process and reporting to the board? Right now, you have to write the report based on the variance analysis. The variance and when you write the answer, you don't want to have a strong relationship with this B1 and B2, right? You can take one case, for B1, another case for B2, another case for B3. So right, you don't want to use the same. You don't want to use the same scenario for all these three. You can use three. So in that way, I have planned this one. Otherwise, it's very hard, right? Like a research thesis, right? But the thing is, you should relate this um, assignment. For example, in the B1, you have choose a soap manufacturing firm. The B2, you choose service firm. B3, chemical manufacturing firm. So it has no relation. So that is totally unacceptable, right? That is not acceptable. So therefore, right, when you choose organization, say chemical manufacturing organization, that B1, B2, B3, right, should be relevant to the chemical production organization. But you don't want to take the same numbers, same figures. You don't want to take, right? If you get the same figure, one case for B1, B2, B3 is fine. But right, uh, so there should be a consistency. If you choose in the A1, if you choose chemical manufacturing company, you have to write your answer in chemical manufacturing firm in that way, right? Because the scenario is one. So one scenario, you have to write answer for task 1 and task 2, each task having three evaluation criteria, three assessment criteria. So therefore, very careful, right? If you choose bread manufacturing firm, bakery, all of the figures should be aligned that bakery, right? Assessment 1, task 1, task 2, right? But we don't have same relationship with the, we don't want to have assignment 2 and assignment 1 and 2 are different, right? We can take two different organizations, but for task 1 and task 2, you should use one particular organization, right? One particular industry. But we can, for budgeting, we can use a different scenario, right? We can prepare different budget. For variance analysis, we can take different values, different text. So you don't want to use this budgeted values in variance analysis. No need. But the context should be one organization, right? So here, evaluate when you look at the questions, evaluate the contributions of budgetary control for achieving objective by designing a control framework. So how a particular organization use budgetary control or variance analysis for, right, for achieving their organizational uh, objectives, and how they use the variance analysis and controlling mechanism, preparing and interpreting variance analysis, design how they are use the contribution of budgetary control to achieve organization objectives by designing a control framework, and preparing interpreting variance analysis. You prepare how the organization prepare and interpret variance analysis. So in your you have to emphasize material, right? Material labor variances and recommending actions. What the things has to be done. So what are the contributions from the corporate top management? What the role of internal audit? What's the role of external audit? So, right, it's a combination of these things. Right, any questions here? Any questions? Right, be serious on this assessment, because it is evaluated by again UK people, PSN people. So please have a look at on that. Right. So now the controlling actions. Once we studied budget, okay, budget's a good thing, good tool for achieving organizational objectives. goal and objectives. So I didn't explain what is cost center. Define the responsibilities in the cost center, revenue center, profit center, investment center. Right. I will explain at this moment. Before I tell the control actions, right? I will explain this. There are 4 different centers. Cost center, revenue center, profit center, and investment center. Investment center. Cost center, it means the place or activity where the cost incurred. For example, when you operate a machine, does it give you any revenue, or it causes a cost? For example, when you operate a generator, like electricity generator in your organization, does it produce any revenue or cost? When you run electricity generator, right, power generator in your organization, right? Not, you are not CEB, right? You are producing chemical products. You are producing, right, fabrics, like things. So you are running generator. Does it give cost? Does cause cost or revenue?
Cost.
Yes, cost. So you have to give some fuels, some maintenance. Other than this, you are not get any revenue from the cost, that machine. So there's a unit. That unit is responsible for operating on maintaining the generator. So that is cost center. Likewise, there are a lot of cost centers in an organization. The accountant, right? The accountant will place in a separate division, right? In head office. He collect cost from each department. For example, generator maintenance unit. So he collect the cost from that unit. Say in that year, 500,000. So this cost arises in that cost center. Likewise, there are a lot of cost centers. Say purchasing unit, or welfare unit, or so there are a lot of units in the company and organization. So they are giving different cost center. They accumulate all the cost. They are preparing cost statements. So that is cost, no revenue incurred. And there are revenue centers like outlet, factory outlet. So what the main thing here? Factory outlet. The main is income. Showroom, right? Showroom. Sales showroom. No much cost here. They are generating, for example, a garments factory, right? Hamidia. They have their own garments. They manufacture the garment and they are selling. They are selling outlets. they're selling their showroom. So people buy the product in that showroom, from that showroom. So it generate, right? That's outlet and the showroom producing revenue. But there are some marginal cost, labor cost, maintenance of the labor. That it's not when compare the revenue, right? When the revenue, the cost is minimal just to maintain that outlet or just to maintain the show. So it's give revenue. So the accountant, right? Accountant accumulate the firm revenue from different showroom, different outlets. So they are pump money to the firm. They are giving money to the firm, revenue, marketing side, sales side. It gives revenue. Cost center responsible for giving cost. Did you get the differences? Did you get the differences? Cost center and revenue center. Is it clear?
Yes.
Is it clear? Okay. Then profit center, right? Profit center, where we can find cost center plus cost and revenue. Assume a retail grocery shop, only one unit. Retail grocery shop, only one unit. There's an owner. There's an owner, or let's take Cargill's Food City. Cargill's Food City. And it has lot of centers, right? So in Candy, that's in a store. So it buys and sells. It buys items for the store, for the supermarket, and their sales. So this Cargill's Cargill's branch. They buy their goods. They buy goods and sell goods. Buy and sell. Right? Buy and sell. So this time, this Candy center is responsible for making profit. Responsible for making profit. Right? So why this Cargill Food City having encounter significant cost, and it generates significant revenue. So therefore, it is a profit center. Here in Cargill Food City Candy branch, there's a manager. Supermarket, the branch manager, he responsible of making profit in the branch. It's a profit center where we can find cost of buying the item inventories and sell of inventory. Buying and selling occur in the same unit. Buying and selling occurs in same unit. Right. So this is what? Profit center. Right? Profit center. Is it clear? The differences: cost center, revenue center, and the profit center. Cost, revenue, profit. Is it clear? Right. Now we move to investment center. Investment center. In the same example, right? My question: the manager, Cargill's Bank Candy branch manager, does he has authority to open another branch or to start a new business within their candy food city, for example, right? For example, in Cargill's food city branch, the Cargill's manager has a uh, plan to open a new business, that is uh, beauty parlor or salon service within Candy branch. Is it possible? Does the manager has authority to take this decision? Yes or no?
No.
Yes or no? Does the branch manager has rights or authority to provide a new kind of business, new product line? Is it possible? Or
Not possible.
can the branch manager has a rights to open new branch of Cargill Food City in that area?
No.
Yes or no? No. He can't make any investment decision. He can't make any investment decision. Who able to take that decision? Who? Top.
Board of
The head office. Head office. Isn't it? Head office able to get that kind of new investment decision. Right? New investment decision. So this head office is the investment unit, investment response centers. So they can decide. Sometime the Candy Food City making loss. Does the manager has rights to close the branch? Does the manager just the branch manager has the rights to close down the branch?
No.
No, he can't, because he can't make any investment or divestment decision. Right? So that is responsible for making profit. When they are making profit, there are two: profit, income and expenses. That's in buying and selling. So that is right, income and expenses. That is profit center. Investment center. If the manager has rights to do so, he able to open new branch, or he can open a new outlet, provide beauty parlor services, beautician center, massage center, or salon. If he has a right, then that is a investment center. But actually, he can't, because that kind of decisions can be taken at the head office. So that is investment center. So when you look at these things, so there's a hierarchy. Cost center, for example, power generator, maintenance unit, power generator, maintenance units, they are responsible at the beginning, right? And revenue centers. So those two are in same level. Cost center and revenue center. And here, profit center. Profit center is a combination of these two, right? And here, investment center, right? So they can able to make new investment or divestment in new investment. So that is what responsible center. Then we have to link these things with the budget. Just read this assessment B2. right? I give you 1 minute. Read this assessment to how you can link this question with cost center, revenue center, and profit center, the budget. How? How does it relate? How you can relate this? How? Right. For that, you see the budgeting, right? In the budgeting. Budget. This is a budget. Right. When you see this diagram, right? When you see this diagram, right? In diagram, see the organizational hierarchy. Organizational hierarchy. Mission, level 3, strategic leadership, right? Objectives, action plan. Who decides vision, mission? Who decides? Say Cargill's Food City. Who decides its vision and mission? Head office or branch manager?
Board of
Head office or branch? Yes, board of directors. It's a top. It's a top corporate people. Vision, top. Strategic goals, sales growth. So those sort of things, top management. Top management will do. Right. Here, top management plus and the director sales, director production, all those people may link on this and they decide here. And the department level, right? And when we go to the department level, department level action plan here, department level 5. So these are level 5, right? All these things are level 5. Say production department. Production department, they will prepare a production plan. Production budget. They will prepare production department will prepare production plan. So that is about production budget. So this is cost center. That's it, cost center or revenue center.
cost center.
Cost center, revenue center. Cost center, because in the production department, they can't make any sales. They can't make any sales. They buy material, they pay labor, labor cost, they buy indirect labor, everything they, right? Major cost center is production department, right? Within that production department, there are a lot of small units, say power generator units and warehouse units, canteen, right? And power supplier, many branches. What about the marketing department? Cost center or revenue center, they are responsible. They are managing, marketing department managing cost units or revenue units. Marketing department. So they're having outlets. They are running sales, right? They promote sales. So mostly they are revenue centers. They are mostly generating revenue. And other departments, research and development. So they also cost center. Finance department, cost center. And HR department, cost center. The major department is, major revenue department is marketing. Right? So they are preparing, they are responsible for such centers. Right. Say Cargill's Food City manager. Right. Cargill's Food City manager, branch manager. Branch manager is a branch. A branch is a profit. It's a profit center. Right. In this unit, right? In this unit, functional unit, he is responsible. That marketing manager, sorry, the manager, Food City manager is responsible for what? Managing cost. Managing cost and making profit. So making revenue. Purchase and sales. Purchase and sales. So there are a lot of branch managers. All outlets, all branches are making revenue. And when you look at the Cargill's Food City, head office, they will decide. Uh, they will decide branches, right? Branches. They open branches. So they decide vision, mission, and their long-term objectives. Right? They're along the goals. So by next year, we have to open this amount of branches and this amount of profit we have to have. So that kind of thing. And they allocate this task among their branch managers. The branch managers, so they are buying, they are responsible for buying and selling their product. Within, right, within their Cargill's branch, Food City branch, say Candy branch, we can find within that branch there are units. So one officer is in charge for buying product, buying goods. So assistant manager procurement. He is responsible for maintaining inventories, right? And so many things. Another manager is responsible for sales. So in the counter, right? The point of sales, they are generating revenue, no cost, right? At the counter, they are generating revenues. And another point, there are manager, he is responsible, he's back end. He purchase and show nicely put all the items in the track. That is cost center, sales outlet, sorry, the counter, so revenue. In the room, so in the branch, that's a profit center, right? That's a profit center. So the Cargill's manager, the procurement manager, right? The procurement manager within the Cargill's Food City, he prepare a budget. This month, we are going to purchase these items. So the prices altogether, we need this amount of money, right? And the sales counter, they prepare, right? We are going to make this kind of sales, right? This kind of sales. But the buying manager and selling manager, right? They sit together and they discuss. They have to decide what they're going to buy, what they're going to sell. And the branch manager control these two units, these two, this cost unit and revenue unit. And he may plan for the next profit, right? So each branch is a profit center, right? Beyond that, manage all the branches, set goals and objective, right? At the head office, the branch manager, the manager at the head office, general manager, accumulate all the budgets from, so the branch manager accumulate the budget from cost center and revenue center and accumulate a budget. And their head office accumulate all what do you call, all budgets, and he prepare master budget, right? Master budget. It will, each branch having its master budget, and all master budgets are accumulated at the head office, right? Each branch manager has to make a control things, right? And variances, everything. Is it clear? Is it clear? Profit center, revenue center, cost center, revenue center, profit center, and investment center. Right? Investment center always at the top. Profit center at the middle. Profit center maintain the cost center and the revenue center. Revenue center is responsible for making budgets, right? That generate revenues. Cost center is responsible for preparing a budget on what are the cost elements there. And profit center accumulate these two budgets and prepare one comprehensive budget. So that is budget for that unit. And there are a lot of units. All units budgets are accumulated at the head office. Right? Clear? Is it clear? If you have any gray area, please let me know. Okay, let us wind up the class. The next class we will yes, yeah.
Sir, but these notes, can we get those? The documents?
Which note? So this one.
Yeah, the ones you are teaching, like with the examples and everything. So if we could get the study material.
Do you want this one?
Yeah.
Okay, I can share this. I can share this WhatsApp. No issue, I can share it. So give me a WhatsApp message, I can share now. So and other than that, any questions? Okay, thank you very much. We will, in the next class, we will discuss about marginal costing. That
Sir,
is
can you
related
share
to.
your phone number once again?
Okay, I will share. Not 76 0 0 1 2 4 8 7. So by the next week, I can teach you marginal costing, the break-even point. So that is related to this assignment 2. That is regarding assignment 2, C1. Next class will be start session on this things. Assignment 2. Okay, thank you very much. If you have no questions, we can wind up the class. Okay, thank you.
Okay, thank you. Thank you.
Thank you, sir.
Welcome.
Thank you, sir.
Welcome.